We know there are two main accounting standards. One is US GAAP and the other one is IFRS. Generally speaking, financial liability classification rules are more similar under US GAAP and IFRS, and therefore this video will be focusing on classification and measurement of financial assets. One of the major differences is that under IFRS, classification of financial assets is based on, first of all, business model within which they are managed, and second, their contractual cash flow characteristics. For example, whether they are solely payments of principal and interest, or SPPI. Okay, all of this might sound boring and complicated, but let's look at a very simple example. Let's use a vanilla government bond as an example to demonstrate that different business models can lead to the same instrument in different classification and measurement. Let's say we have trading desk A, B, and C. They all have vanilla government bonds in their portfolio. Desk A's intention is to buy the government bond for trading. They intend to hold the bond for a short period of time and sell it. Typically, a bond trading desk in an investment bank as a market maker will be actively engaged in buying and selling bonds. Because of this intention, the government bond in this case will be classified as held for trading. And in terms of measurement, they will be fair valued through profit and loss account. So the trader will see their mark-to-market gains and losses on the bond on their profit and loss account on a daily basis. Desk B's intention to hold government bonds is to collect a bond coupon and would only be selling the bond in a stress case scenario. Otherwise, Desk B will hold the bond until maturity. Because of this intention, the bond will be classified as held to collect and will be measured at amortized cost. And finally, Desk C's intention to hold government bonds is to both collect the coupon and, depending on the market condition, they are also prepared to sell the bond. Therefore, both collection of cash flows and sales are integral to Desk C's business model objective. Typically, a market treasury desk would hold large amounts of bonds with this business model, and they will be classified as AFS, so that's available for sale. In terms of measurement, they will be valued through other comprehensive income, which is part of the equity in the balance sheet. Another example is SVB, the bank that went bankrupt in early 2023. The bank has a large portfolio of AFS. The mark-to-market loss of the AFS is not recognized in the daily P&L, but through the OCI on the balance sheet as unrealized P&L. And when they are forced to sell the AFS portfolio, they had to realize the loss in OCI. But of course, there are many other issues like increased interest rates and liquidity management, etc. Thanks for watching. I hope this brief introduction of classification and measurement is useful. I have other videos to explain in detail what is a fair value, and I'll provide a link below. I will see you in the next session.